Forex, foreign exchange exposure and risk management. Who are the market participants in Forex market? The participants in the foreign exchange market can be categorized as follows. First one, non-banking entities. Many multinational companies exchange currencies to meet their import or export commitments or hedge their transactions against fluctuations in exchange rate. Even at the individual level, there is an exchange of currency as per the needs of the individual. Second, banks. Banks also exchange currencies as per the requirements of their clients. Third, speculators. This category includes commercial and investment banks, multinational companies, and hedge funds that buy and sell currencies with a view to earn profits due to fluctuations in the exchange rates. Next, arbitrageurs. This category includes those investors who make profit from price differential existing in two markets by simultaneously operating in two different markets. Next, government. The governments participate in the foreign exchange market through the centralized banks. Example, RBI. They constantly monitor the market and help in stabilizing the exchange rates. Next, what are the techniques used in exchange rate forecasting? Techniques of exchange rate forecasting. There are numerous methods available for forecasting exchange rates. They can be categorized into four general groups: technical, fundamental, market-based, and mixed. Technical forecasting. It involves the use of historical data to predict future values. For example, time series models. Speculators may find the models useful for predicting day-to-day movements. However, since the models typically focus on the near future and rarely provide point or range estimates, they are of limited use to MNCs. Next, fundamental forecasting. It is based on the fundamental relationship between economic variables and exchange rates. For example, subjective assessments, quantitative measurements based on regression models, and sensitivity analysis. In general, fundamental forecasting is limited by the uncertain timing of the impact of the factors, the need to forecast factors that have an immediate impact on exchange rates. Next, write short notes on PIPs. PIPS, PIPs. PIPS is another technical term used in the market. PIP is the price interest point. It is the smallest unit by which a currency quotation can change. Example, USD per INR quoted to a customer is INR 61.75. The minimum value this rate can change is either INR 61.74 or 61.76. In other words, for USD per INR quote, the PIP value is 0.01. PIP in foreign currency quotation is similar to the tick size in share quotations. However, in Indian interbank market, USD INR rate is quoted up to 4 decimal points. Hence, minimum value change will be to the tune of 0.0001. Spot Euro per USD is quoted at the bid price of 1.0213 and an ask price of 1.0219. The difference is USD 0.0006 equals to 6 pips. Next, what do you mean by merchant rates? It is always interesting to know who fixes the exchange rates as quoted to the customer and to realize that nobody fixes, but the market decides the exchange rate based on demand and supply and other relevant factors. RBI often clarifies that it does not fix the exchange rates, though in the same breath, RBI also clarifies that it monitors the volatility of Indian rupee exchange rates. In other words, RBI does not control the exchange rates, but it controls the volatile movement of INR exchange rate by intervention, that is by deliberately altering the demand and supply of foreign currency, say USD, US dollars. It does it by either buying USD from interbank market or pumping in USD into the market. This wholesale interbank market rate is the basis for banks' exchange rates quoted to the customers. In foreign exchange market, banks consider customer as merchants for historical reasons. Exchange rates applied to all types of customers, including that of converting inward remittance in USD to INR, are called as merchant rates as against the rates quoted to each other by banks in the interbank market, which are called interbank rates. Interbank rates plus exchange margin gives merchant rate. Interbank rate means bank to bank rate. Merchant rate means bank to customer rate. Next, what do you mean by broken period forward rate? Forex dealers normally quote forward rates at regular intervals like 1 month or 3 months. For example, dealers normally quote 1 week, 2 week, 1, 2, 3, 6 months forward rates. However, depending upon the customer's requirement, these dealers quote forward rates on a specific future date that is not an exact multiple of months. Such kind of forward quotes are known as broken period quotes. Banks normally quote broken period rates by method of interpolation. Write a short notes on interest rate parity theory. Interest rate parity theory IRP is no arbitrary condition representing an equilibrium state under which investors will be indifferent to interest rates available on bank deposits in two countries. The fact is that this condition does not always allow for potential opportunities to earn riskless profits from covered interest rate arbitrage. Covered interest arbitrage. Interest rate parity theoretical formula 1 plus RD divided by 1 plus RF equals to F by S. F means forward rate, S means spot rate, R means interest rate in domestic market, RD means interest rate in domestic market, RF means interest rate in foreign market. High interest rate in India has been offset by depreciation in the currency of the India, thus eliminating any possibility of arbitrage opportunity. When interest rate parity exists, then higher interest in one country will be offset by depreciation in the currency of that country. Interest rate parity theory states that size of forward premium or discount should be approximately equal to interest rate differential between two countries in consideration. Write a short notes on purchasing power parity theory. Purchasing power parity theory, PPP, is an economic theory and a technique used to determine the relative value of currencies, estimating the number of adjustments needed on the exchange rate between countries in order for the exchange to be equivalent or on par with the each currency's purchasing power. PPP theoretical formula is F by S equals to 1 plus ID divided by 1 plus IF. ID means inflation rate in domestic country, IF means inflation rate in foreign country, F means forward rate, S means spot rate. Two forms of purchasing power parity theory. First one absolute form, second one relative form. First one absolute form. The purchasing power parity theory is based on the common sense idea. If basket of goods cost rupees 1000 in India and the same goods cost $25 in US United States, then the purchasing power parity between the two currencies is rupees 40 per US dollar. This form of exchange rate is called as absolute purchasing power parity. The absolute form, which is also known as law of one price, states that price of similar product of two different countries should be equal when measured in common currency. Next, the relative form. The relative purchasing power parity explains the relationship between inflation rates and exchange rates of two countries. It means that if the inflation rate in one country is higher than that in the another country, then the effect of this high inflation is offset by depreciation in the currency of that country. Write a short notes on types of foreign exchange exposures or operations in foreign exchange market are exposed to number of risks. Discuss type of exposures in foreign exchange. Foreign currency exposures are generally categorized into following three distinct types. First one, transaction exposure. Second, translation exposure. Third, operating exposure. First one, transaction exposure. It measures the effect of an exchange rate change on outstanding obligations that existed before exchange rate changed but were settled after the exchange rate changes. Thus, it deals with cash flows that result from existing contractual obligations. Translation exposure, also known as accounting exposure, it refers to gains or losses caused by translation of foreign currency assets and liabilities into the currency of the parent company for consolidation purpose. Translation exposure is also called as accounting exposure, is the potential for accounting derived changes in owner's equity to occur because of the need to translate foreign currency financial statements of foreign subsidiary into a single reporting currency to prepare worldwide consolidated financial statements. Translation exposure arises due to need to translate foreign currency assets and liabilities in the home currency for the purpose of finalizing the accounts for a given period. A typical example of translation exposure is the treatment of foreign currency loans. Next, operating exposure. It refers to the extent to which economic value of a company can decline due to changes in exchange rate. It is the overall impact of exchange rate changes on the value of the firm. The essence of economic exposure is that exchange rate changes significantly alter the cost of firms' inputs and the price of its outputs and thereby influence its competitive position substantially. Explain the strategies for exposure management. Strategies for exposure management. A company's attitude towards risk, financial strength, nature of business, vulnerability to adverse movements, etc., shapes its exposure management strategies. There can be no single strategy which is appropriate to all businesses. Four strategy options are feasible for exposure management. First one, first strategy, low risk, low reward. Second strategy, low risk, reasonable or high reward. Third strategy, high risk, low reward. Fourth strategy, high risk, reasonable or high reward. First one, low risk, low reward, involves automatic hedging of exposure as soon as they arise, no matter how much attractive the forward rate is. Management here is not required to invest any time and money and can focus on their core area of business. But this option is hardly likely to result in optimum costs. Businesses whose costs significantly depend on the commodity prices can hardly afford not to take views on the price of the commodity. Hence, this does not seem to be an optimum strategy. Next, low risk and reasonable reward or high reward. This strategy requires selective hedging of exposures whenever forward rates are attractive, but keeping exposures open whenever they are not. Next, high risk, low reward. Leaving all exposures unhedged is the worst strategy. Only the benefit is that management is not required to invest any time or investment. High risk, high reward. This strategy involves trading actively in the currency market through continuous cancellations and rebookings of forward contracts. Few of the larger companies are adopting this strategy in India. That is short notes on Vostro, Lostro, and Loro account. First, nostro account. It is an Italian word. Nostro means ours. Hence, nostro account points at our account with you. Nostro accounts are generally held in foreign country with a foreign bank by a domestic bank. From our perspective, our bank. It obviates that account is maintained in that foreign currency. Example, SBI account with Bank of America is nostro account for SBI. Next, vostro account. It is also an Italian word which means yours. Hence, vostro account points at your account with us. Vostro accounts are generally held by foreign bank in our country with a domestic bank. It is generally maintained in Indian rupee if we consider India. For example, SBI account with Bank of America is vostro for Bank of America. Next, Loro account. It is also an Italian word. Loro means theirs. Therefore, it points at their account with them. Loro accounts are generally held by third-party bank other than the account maintaining bank or with whom account is maintained. For example, ICICI wants to transact with Bank of America but does not have any account, while SBI maintains an account with Bank of America. Then ICICI would use that account. It is called as Loro account for ICICI Bank.